Good morning and welcome to this Monday, April 11th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, looks like we're going to get off, excuse me, to a little bit of a rough start this morning. We've got futures lower. NASDAQ futures last check were down roughly about 1.25%. S&P 500 futures down about 0.75%. So looks like we're breaking back down, especially on the NASDAQ. The chart technically is tilting much more to the right, moving below key moving averages. That's not a good thing. What it really means to me more than anything is that the uptrend that we've been enjoying since that March 14th bottom, once we're unable to hold on to those rising moving averages, that starts to paint much more of a consolidation picture than a trending picture. So definitely brings the February lows back into play. We'll see how things move here over the next few weeks, but there are a lot of reasons to at least be concerned about where we're headed. I wrote an article over the weekend, my Chart Watchers article, which was please do not ignore these 3 warning signs. And if you didn't have a chance to read that, you may want to go back and take a look at that. But there's a lot more than 3 warning signs, but those were the 3 I thought that were pretty important given, the way the market has set up right now. And I'll point that out and go through that in just a couple of minutes. Let's go ahead and first, for those of you that are new to Earnings Beats, take you over to our website at Earnings Beats. So if you go to earningsbeats.com and scroll down, we've got an area where you can sign up for our free Earnings Beats Digest newsletter. That's a newsletter that I write 3 times a week, Mondays, Wednesdays, Fridays. Very, very quick, usually a couple paragraphs and a chart kind of read. I like to focus on the things that are really important to us at Earnings Beats. So it's going to be a lot of focus and attention centered around things like relative strength, earnings, gaps, candlesticks, moving averages, trend lines. There's going to be some fundamentals and also some technicals thrown in at the same time. So all you need to do is type in your name, email address, and hit that subscribe button, and we'll get you set up. It's free, no credit card required. You can unsubscribe at any time. We'd love to have you. But just go to earningsbeats.com, scroll down, and you'll see that there. Moving on to the action from Friday, Dow Jones Industrial Average finished up 137 points. S&P 500, however, was down 12, and the NASDAQ was down 186. So you can see the bifurcation that took place on Friday with the Dow actually rising while the S&P and NASDAQ were hit. NASDAQ hit the hardest at minus 1.34%. Mid caps relatively flat, just down a fraction. S&P 600 small cap index down about 0.6%. So it was down almost 8 points. But across the board, with the exception of the Dow, we were seeing lower prices on Friday. A couple of pieces of good news, a couple of areas of the market that we're working on Friday: energy and financials. Energy up 2.75%. Financials were up a little more than 1%. To the downside, however, it was that familiar group of aggressive areas of the market: technology, discretionary, industrials joined the party there. But technology down 1.4%. And you can see this is the problem with the market right now. Technology is the largest area of the S&P 500. It accounts for roughly a quarter of the S&P 500. Discretionary is the second largest, and you can see that group is struggling as well. Once you start giving away these key moving averages, it looks like you're trending down below the moving averages. So you got the 20-day moving average below the 50-day and price action below. Clearly, we were trending lower. Once you come back up above the 20-day and the 20 crosses the 50, you get that golden cross. It starts to look more like an uptrend. Prices are above the 20, which are above the 50. Well, it doesn't look much like an uptrend when you fall back below those. moving averages. So now the question is, do we just simply meander back and forth above and below, in a consolidatory type fashion? Or are we literally going to start another big downtrend? My guess, based on, everything I'm seeing at this point, I would say the odds probably favor more consolidation. Maybe we go down and test the low, maybe slightly go below it. That's what I would be thinking at this point during any weakness ahead, is that we're just going down for maybe a retest of those previous lows. Can we rule out a breakdown? Of course not. The market can do anything it wants to do. We could be in this downtrend for the next 10 years. I don't believe that's the case. I believe we're still in a secular bull market. But in the short term, we have to respect these breakdowns that we're seeing in some key areas. Financials, even though financials came back on Friday, financials had already broken down. And look at this configuration, the price action below the 20, which is below the 50. So yeah, we had a nice little bounce on Friday, but I certainly don't feel like financials are out of the woods. And by the way, all this weakness on the financials is taking place with the yields rising. Normally there's a pretty strong correlation between yields rising in the US and financials performing well. That's not the case. And as I've said before, from my background in public accounting and having audited banks, interest rates can go up for a number of different reasons. If it's because the economy is strengthening or is expected to strengthen, those rising yields can play quite favorably into the financials, into that area of the market. But if yields are rising because everyone's bailing out of the bond market because of inflation fears, that's a different animal. That's not anything that's helping the banks. So, I mean, if anything, yeah, you might see mortgage rates going up, but the problem is, as short-term rates go up with the Fed tightening, banks are going to be pressured to pay more on their deposits. So the problem is that the spread between the two doesn't really widen. And if anything, as the economy weakens, banks don't really want to lend. And that's the problem. We're definitely an economy that depends on the availability of credit. And when banks decide to kind of rein in a little bit, and they become less aggressive in lending, that can choke off the economy. So that's just another reason why I think we are either heading into a recession, or certainly there's going to be a lot more discussion of it. And I've been talking about a recession for the last few months. You're starting to hear it from the media now. And I even warned that that's what was going to happen. That was going to be the next step. I mean, I've pretty much been giving you each shoe that's about to drop ahead of time. And recession is going to be the next one. It's going to be the big talk of the summer. I mean, how can it not be when the Fed says they're going to raise 12 times, 9 times this year, 3 times next year? Now, do I think they're going to raise that many times? No, I don't think it'll be anywhere close, but they're saying it. And it's probably smart that they say it so that the market gets its focus off of inflation, which I think will be the case later this year. But inevitably, it's going to have an impact on the economy. And that is going to be the problem. 10-year Treasury yield. Let's get a quick update here. Make sure I got the latest. 2.75%, up another 4 basis points today. So that yield just keeps climbing. This is what I was referring to, the financials. Notice how, when you watch the 10-year Treasury yield, and it's more about, I think it's more about the yield curve than it is about the 10-year Treasury yield as far as what happens with financials. But generally speaking, when you watch the yield, the 10-year Treasury yield, you can kind of expect what's going to happen to financials relative to the S&P 500. So on the way down here in the yield, you can see financials drop on a relative basis. Then we start moving back up, and financials move back up on a relative basis. Down, down, up, up, down, down, up, whoops. And we don't follow. Financials over the last month have not been following the yields to the upside. Normally we perform better. Why is this the case? Well, it's a couple of things. Number one, it's the inflation worries, but we've had inflation worries for last year. I don't think it's the inflation as much as it is now the recession worries. And that is why I think we're starting to see, in my article over the weekend, this was the article I wrote. So please do not ignore these warning signs. Talked about defensive sectors. I'm going to talk about those again in just a minute. Inflation, we got two big inflation reports coming up this week. We got the CPI coming out on Tuesday, tomorrow, and then we've got PPI coming out on Wednesday. That's pretty much all the economic news we have for the next 3 days. Those are the two big reports. So anyway, I went through and just kind of did a quick little math. It's a very simple computation to figure out what the annual core rate of inflation is going to be at the consumer level. We're going to drop the March 2021 level, which was 0.31, and then we're going to add the March level. I estimated 0.6%. I think Econoday is looking for 0.5%. But either way, the replacing number, unless we come in below expectations, the replacing number is going to be higher than it was in March, which means our annual inflation rate is going to go up at the core level. So just brace yourself. Be ready for the headlines tomorrow. Now, here's the good news. And this is what I was talking about. I've been predicting that inflation peaks in April of 2022. And the reason I say that is we're going to get that March reading, which is likely to be higher than what it replaces. But the next 3 months, look at these readings from last year that we're going to be replacing. April rose 0.85%, May 0.75%, and June 0.8%. Since those three readings, and that's when we really took off with inflation, was this time last year, heading into the spring, early summer. As we get rid of these numbers, look at the numbers that have come in since then. Since these three, nothing really that close. 0.3, 0.2, 0.2. Now we've been pretty steady in the 0.6, 0.5 range, mostly around 0.5. But if we just stay there, the next 3 months, we're going to see probably close to a 1 percentage point drop in the annual inflation rate by the time June is released in July. So by the time July 22 comes around, we're probably looking at the annual inflation rate back down around 5.5%. What's the narrative going to be? What's the media going to say? Well, the media is not going to talk about it because it's heading in the right direction. The media is going to start talking about the recession. So get ready for that. Inflation's been a big news item as long as it's going up. But when it starts coming back down, you're not going to hear much about it. But today or tomorrow, when this CPI comes out, you're going to see a spike. Just be ready for it. Okay, I mentioned the economic report, so not a whole lot coming out this week in terms of, or at least not the first half of this week, just the two inflation reports, which are pretty big reports, by the way. Thursday, though, we do have, of course, initial jobless claims comes out every Thursday. Retail sales and consumer sentiment. That last one, consumer sentiment's big because it's been dropping for a year now. And I've got a chart I'll show you as we go through the show. I'll talk a little bit more about consumer sentiment. And it's been dropping very, very rapidly. You might not realize it, but it's been one of the biggest drops in the last 4 decades in the last year. So consumer sentiment and consumer confidence, those are two really big economic reports because they tell us a lot about what the consumer is thinking. And our GDP is 2/3 consumer spending. So I think they're really good leading indicators. And if you're looking at consumer sentiment, when I show that chart to you, you'll understand why I'm worried about a recession. Okay, let's keep moving here. Sector. So I wanted to talk a little bit about the sector summary. One of the warnings I showed you in that article, if we go back over here to that article, this was an RRG, a relative rotation graph. It's a weekly graph, goes back to last year. And I've set the tail length to 12 weeks. So if you're not familiar with the RRG charts, what happens is you've got these 4 quadrants. You've got leading, weakening, lagging, improving, back to leading. And so a lot of times, different asset classes, different sectors, even stocks within the sectors, industry groups, they go through these cycles of where they're leading and then they're weakening and then they're lagging, improving. A lot of times strong areas will go into leading, come down into weakening, and rather than go into lagging, they go right back up into leading. So you have a really strong group that just takes a break. You see some profit taking, move into the weakening, and then right back up. Now, I want you to look at what is over here in the leading and weakening area and what's over in the lagging area. The key here to me is the lagging. XLK, technology. XLY, consumer discretionary. XLC, communication services. These three groups are the three groups that are lagging really badly. And these are the three groups that we really want to lead the market. So we can sit here and say, well, we want the market to go higher. Well, it's not going to until these three groups start to move back in that northeast direction. And Julius de Kempenaar, who is the creator and founder of the relative rotation graphs, Julius and I are really good friends, and we've talked about this a lot. I have him over occasionally on my shows, and just really fascinating. I love talking to Julius about the rotation because he, like I said, he did create this, which I think is just brilliant, genius. But until you start moving back to the right, I mean, it looks like XLC was starting to, and then it went back. Look at the XLK. It's coming down into the lagging area and starting to turn up, and then it puts a left turn signal on. So now all of a sudden, instead of heading back to the northeast, it's now starting to head west again. That's not good. West, if you're moving left on this chart, this is the relative strength chart right here. So left of this vertical line right here is weak relative strength. If you're on the right side of it, it's strong relative strength. Of course, you have to have your benchmark. And so the benchmark that I have versus the sectors is a spider. So I'm just comparing our major sectors versus the spider. The only thing you'll see missing on here is the XLE and the XLB, energy and materials. I've really just wanted this chart to focus on the aggressive groups and the defensive groups. And you're going to find all of the defensive groups over here in leading and all of the aggressive groups in lagging. That is not what's going to carry the stock market higher. So there's a lot of work still to be done before we can begin to think about all-time highs again. Wall Street is still sending us a message that we really don't want to be in these groups yet. And if Wall Street doesn't want to be in them, we don't want to be in them. That's what relative strength tells us. But down here, look at this. I made a little Wizard of Oz reference here, but home builders, truckers, and banks. Oh my. Home builders, look since the beginning of the year. So home builders were breaking out in December to new highs, but look at their relative strength down here. So this again is the beauty of relative strength. Absolute strength, if you're looking at that, you're just saying, wow, it's looks good, going higher, it's breaking out. What's wrong with that? Well, except relative to the overall S&P 500, it was nowhere near breaking out. It was leading the S&P back in May of last year. It wasn't doing that at the end of the year. Now look at where it is on a relative basis. Home builders at almost a two-year low. Makes sense. Your mortgage rates are going up. And especially if you start thinking about the economy and a possible recession, it makes sense that home builders would be going down. How about truckers? This one was the most unbelievable chart of the three. Truckers were at a 3-year relative high in mid-March. 3 weeks later, they're at a 3-year relative low. Now, I don't know what the heck happened, but I think it is the market just saying recession, screaming recession. Think about what truckers do. It's a really simple business model. They ship goods. They don't have other business, not like Amazon that's got their fingers in everything. Truckers ship goods. When Wall Street tosses truckers out like this over a 3-week period, I mean, that's screaming to me there's something going on with the economy. I think Wall Street's saying they're going to be shipping fewer goods. And why would you do that? Well, the economy slows. That's why. And then you got banks. Now, banks, in my opinion, I think this is setting up for a pretty nice rebound later this year. I don't know when, but I'm not nearly as bearish the banks. Now, relative to the S&P 500, they did just break down. So this is about a 15-month relative low. Noteworthy. I mean, we need to be aware of that. The 10-year Treasury yield versus the 2-year Treasury yield is what a lot of economists look at in terms of the yield curve. And when that goes negative, that's when folks start thinking recession, because it's going to squeeze the margins of banks. And if they're not making money, they're going to stop lending, and it just cuts off the credit availability to our general economy. So that's what that's what you're going to see in the media is the 10-year versus the 2-year. And oh my gosh, it just inverted. Now, having audited banks, I actually look at the 10-year treasury versus the 3-month. I think the 3-month is much more indicative of what the banks have to deal with on the short end. This is what's going to be moving much more rapidly, the 3-month with the Fed rate hikes, Fed fund increases. So I just think this versus the 10-year treasury yield makes more sense to me. And I actually looked at it on using correlation versus the relative performance of banks versus the S&P 500. And when this spread is going up, banks tend to do better. When this spread is going down, banks tend to do worse. Well, right now it's going up, which you would think would be good for banks, but banks on a relative basis are breaking down. Now, I think a lot of it has to do with the narrative and the media and, oh my gosh, inverted yield curve, the 10-year and the 2-year. And so I think a lot of this is being, I don't want to say orchestrated, but I think it's being orchestrated, manipulated, call it what you want. I think this is a group that's going to bounce back. Is it going to be this week? Probably not. This month, I don't know. Probably this year, though, or into next year. I think the banks will be just fine. But in the near term, if the market keeps selling off, this may be one of the areas, especially as the recession rhetoric picks up pace. Banks could be a casualty in the short term. Anyway, that I thought was an interesting chart and kind of ties in. All of those charts are interesting, but that all ties into what I wanted to show here. This is just a 1-week sector performance summary. And I want you to look at the groups leading: healthcare, energy. I'm not really concerned about energy right now, but healthcare, consumer staples, utilities, and real estate. Those are your 4 defensive groups. How about your 5 aggressive groups? They're all at the bottom: financials, communication services, industrials, consumer discretionary, and technology. Look at this. I mean, this isn't a little bit of spread. Healthcare outperformed technology by 7 percentage points last week. The S&P 500 went down 1%. So what is that telling you? Well, it's telling me that Wall Street is completely repositioning out of some of these aggressive areas and moving into the more defensive areas. This is what we saw back in December, right before the market took a big hit. So when you look at the S&P 500 chart, actually, let me see if I have there's a daily chart right here. So look at this rally. First of all, here was the rally at the end of December. And we had the same setup at the end of December that we had last week. We had defensive groups pushing the S&P 500 to those highs. And what happened after that? Well, after Wall Street got repositioned into defensive groups, went down. And we've seen pretty weak action across a lot of different areas from January through March, first quarter of this year. I want to show you, anybody who's new, I want you to check this out. So here's the S&P 500 going down. Now, one of my favorite sustainability ratios, I do a lot of intermarket relationship work. And one of my favorites is the XLY versus the XLP. Very simple. Consumer discretionary stocks versus consumer staples. Why is that important? Well, it's telling you where consumers are focused. Discretionary stocks, they represent companies that sell us the things we want. Staples companies sell us the things we need. Big difference. When you're feeling really good and bullish about things and you feel like you've got a lot of money to spend, your 401k is going up and job's good and interest rates are, low, you got your mortgage paid, maybe even paying in some extra principal, and just you're feeling really good about things. You don't mind going to Starbucks and buying that latte. You don't mind taking that old car and trading it in and getting a new car. If you're really feeling bold, you almost, feel like maybe I'm going to move up in terms of my house. I'm thinking about selling my house, getting a nicer home. Those are the things you do when you feel good about things. You buy the things you want. When you're not feeling good about things, you start cutting those purchases out. But the consumer staple side of things, they sell you bars of soap. They sell you toothpaste. They sell you deodorant. These are the things we need. We don't buy these things because we want them. Well, maybe you do want them. You want to brush your teeth, I hope. But no matter what the economy is, you're going to buy the same amount of them. It's not like the economy's strong, you're feeling really wealthy, and you're going to go out and double your purchase of toothpaste. That's not what's going to happen. You're still going to buy the same amount of toothpaste. So anyway, the relationship between these two, I can't overstate it. I think it's really, really important. And if you look at the long-term correlation between the relationship between consumer discretionary and consumer staples, that correlation ties very, very strongly with the direction of the S&P 500. Look at the S&P going up. Look at the XLY, XLP going up. This is just the last year, but we could go back 40 years. Well, XLY, XLP is only out for the last 22 or 23 years. But this relationship is very important. It goes back. It definitely stands the test of time. Look at the December move on the S&P to a new high. And look what was going on here with the XLY, XLP. I can promise you, we're not going to look at it today, but I can promise you, go back to 2007, the financial crisis right before that hit, and look at this ratio. It was falling apart for the last 2 years. 2005 to 2007, the XLY and XLP were moving lower. When the S&P 500 topped in October of 2007, the XLY XLP ratio was at a 5-year low. It's unsustainable. The S&P can't go up if money is not rotating into consumer discretionary. Well, I shouldn't say can't go up. It did go up. It's just not a sustainable type of move. Anyway, as we move down, look at this relationship. Then we move back up. We had a nice little pop, but we're not far from breaking down to a new low again on the XLY XLP, and the S&P is still way up here. Again, this move to the upside to me just does not feel sustainable. And when I look at the sector for, the sector summary for last week, this is telling me Wall Street's moving back into defense. You combine all that, and it's hard not to be a little bit more bearish. This other chart, this is an hourly chart of the S&P 500. I'm not going to annotate it, but you can kind of see it going up here, topping at 45.25, coming down to about 44.55. I look at that as the left shoulder right here, neckline, head, come all the way back down right here to 44.50. That's the neckline, slightly down sloping. Where do we go back up to? 45.25 to put in the right shoulder. I see a head and shoulder pattern here on the hourly chart. And so today's move, if it goes below 44.50, would be breaking down this head and shoulder pattern. So you've got a short-term potential bearish pattern that's breaking down and a longer-term pattern that looks like it's unsustainable. That is not a good combination. Now, could the market go higher? Sure. We're in a secular bull market. I've seen crazy things in a secular bull market. But I think it pays to be very cautious right now. I wanted to mention this was that University of Michigan consumer sentiment. This is a 40-year chart that plots the monthly readings of the consumer sentiment. And look at where we were in 2020, right before the pandemic hit. We went down, and then we bounced back up for a year, got all the way back up to about 90. And now over the last year, we have been going straight down in consumer sentiment. Not a good look. Not a good look. 2007, you remember the stock market got hammered in 2008? 2007, we were going down for a year before we ever got into 2008. Consumer sentiment was already dropping. 2000, look at 2000. The year 2000 was dropping. 2001, 2002 is where we took the big hit in the stock market. 1990, we had a recession. We had the Persian Gulf War. Look at the huge drop in consumer sentiment there. I have a 12-month rate of change of consumer sentiment down here at the bottom. If you put in rate of change, 12 periods, it's a monthly chart. There's your monthly chart. So this is a 12-month rate of change. The consumer sentiment is down 30% over the last 12 months. Only twice in the last 40 years have we seen a steeper drop. 2008 and 1990. Both recessions. 1990 was more mild. Obviously, it was pretty bad recession. They call it the Great Recession from 2008. And of course, we did go down close to this level back in 2020 with the pandemic. Of course, we had the recession there. This is a pretty strong reading. I mean, here in 2001 or beginning of 2001, we were minus 20. but we don't get down to this level very often. And it usually just doesn't happen and the stock market goes on about its business. It usually happens during or just before a pretty big drop in the stock market. So just be aware that that's there. All right, to wrap the show up, I'm just going to talk about a couple of banks that'll be reporting this week. Let's take a look at their charts. First one, JP Morgan, probably one of the most recognizable bank names. They'll be reporting their earnings on Wednesday. Just a couple of things I want to point out. Number one, the AD line, their accumulation distribution line, has been going down now for probably about 7 or 8 months. That's not good. That's just telling me that there's a lot of afternoon selling, which is usually typical of distribution. I don't think that JP Morgan, I love JP Morgan long-term. I think it's a wonderful company, great bank. So I would have no problems holding it from a long-term perspective. Short-term, though, I don't really expect it to have the best report coming out among the banks. You've got the AD line going down. Price action's been going down. Relative strength is starting to pick back up again here over the last 3 or 4 weeks. So if there's one positive on the chart, I'm going to say that's it. So we haven't quite, I mean, you can see the banks have gone down basically to the lows they established back beginning of March. And here you can see JP Morgan didn't quite go down to those lows. So it's starting to show a little bit of relative strength. That's your one little silver lining. Is that enough? I don't know. I would be a little careful with JP Morgan. Wells Fargo will be reporting this week, and Wells Fargo, I think, does look really good to me, or at least better than JP Morgan. The AD line is more sideways over the last few months. Price action's more sideways. There's your double bottom. Wells Fargo also did not go back down to that prior low. And you can see on a relative basis, the banks right here, Wells Fargo is near a 52-week high. So if you look at the two of them, Wall Street is basically placing its bets on Wells Fargo, and it's not on JP Morgan. And so I would expect that Wells Fargo is probably going to come out with the better numbers this quarter based on their relative strength. One other that I'll bring up here is Citigroup. This might be the worst bank. AD line's bad, price action's horrible. Look at the relative weakness, Citigroup versus banks. It's been going down for many months relative to its peer group. So when you've got a stock like Wells Fargo that's up near its 52-week high versus its bank peers, and Citigroup 52-week low versus its bank peers, to me, there's not even a question which one you'd want to be involved in. Clearly, it's Wells Fargo versus Citigroup. Now, does that mean that Wells Fargo is going to have a better reaction to earnings? I have no idea. It's a coin flip. But if I do think the odds are better that Wells Fargo is going to have a better report, I wouldn't be surprised if Citigroup were to miss on revenues or something like that, whereas Wells Fargo would expect maybe beats. But that doesn't always mean a stock goes higher. We know there's buy on rumor, sell on news, sell on rumor, buy on news. A lot of things happen. You get, market moves in one direction, then great news comes out and then it goes down. And then everybody who reads the news and jumps in wonders what the heck's going on. Oh, the stock market's fixed. Well, it's not fixed. It's just, well, it kind of is, but you just have to know how it's fixed. Wall Street already knows a lot of this news beforehand. And so that's why you see a lot of this, the bullishness already built into stocks, or bearishness built into stocks before the news hits. All right. Anyway, that's about what I had for today. Let's go ahead and wrap this up. Right now, Dow Jones down 106, S&P down 33, NASDAQ down 192. So NASDAQ again getting hit. NVIDIA down another 5%. I tell you, the semiconductors are really not looking great. I will pull up one more chart. I wanted to see where they are today. Look, I mean, we're down near this March low. This is a very influential group in the market, especially in the NASDAQ. So we've got tremendous support here at about 7,200 down to maybe 7,000. We are now only a few percentage points away from breaking below all of these lows in a very influential part of the market. It's hard for me to be bullish the stock market when I see semiconductors absolutely falling off a cliff. They've now gone down almost 20% in the last 9 trading days. A bear market in 9 days. That's basically what semiconductors have been. And for those who are saying, well, the S&P is not in the bear market because it hasn't gone down 20%. Well, I would just challenge you and say, well, look at some of the areas of the market. Look at the semiconductors up at 97.50 in November, now 72.50. That's well over 20. It's close, probably 25%. So are we going to say that the S&P, that we're not really going through a bear market just because we have certain areas of the market holding the S&P up literally by, its fingernails? I think we're in a bear market. Call it what you want. I think it's a cyclical bear market. I don't think it's going to last. I think we're going to have a great buying opportunity. I don't know if right now is it. Might be next week, might be next month, and it might be in September. Could be over the summer. But I do think we have a great buying opportunity setting up. I would use the weakness this year to buy into favorite positions or ETFs or whatever it is that you are interested in. And by the way, later today at 4:30, I will mention we are having a sneak preview. It's a free event. Everyone's invited. But we're having a free event to discuss how we put together our model ETF portfolio, which is ahead of the S&P 500 this quarter by more than 2 percentage points, which is kind of a big deal for a quarter. But if you want to see, how our current model ETF components are doing, and they will end the quarter on April 19th. So it's next Tuesday. But if you want to hear about that, and then also some of the things I'm going to be looking at in trying to put together our model ETF for the next quarter, and that draft, I call it the draft, will be next Tuesday night. So if you're interested and you want to come in and take a look at that, if you trade ETFs or just like to see what I think about the market and where I'm looking, you can come in tonight. The best way to do that, by the way, is to go to earningsbeats.com and sign up for our free newsletter, because before the event tonight, we will send out an email with room instructions, webinar and room instructions to come in and listen to the event. So make sure you sign up there. All right, that's it for me. Appreciate everybody tuning in. I'll be back tomorrow over at Stock Charts TV. So if you go to stockcharts.com, you see this link right here, Stock Charts TV, 9 a.m. tomorrow morning. Click on it, and you'll get my latest Trading Places show over at Stock Charts. Anyway, everybody have a great day today. Be careful out there. Big CPI report tomorrow. Don't forget that. Take care. Happy trading.